Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. More optimism in the markets has the market moving a little bit higher once again. We're going to try and find out why when we talk with Steve Reitmeister, our editor-at-large, Charles Rotblood, our senior market analyst, and top stock screener and market technician Kevin Matris here at the round table. So that's the question. I mean, earnings season got off to a solid start.
Right.
That's an optimistic piece of news. But Kevin, what's going on? Why the rally again?
Simply put, earnings are better than expected. Company after company has been able to beat the street. And even if they weren't able to beat the street, a lot of these companies that have come in with, mediocre performances, they have had some halfway decent things to say about the future. That's not to say that everybody is thinking that times are great. I mean, everybody is acknowledging that the economic times are very, very tough. But I think what's happening right now is simple. Everybody had been pricing in, as I have said over and over before, everybody had been pricing in this doom and gloom scenario. So the rally that we had seen from March to where we are right now was basically taking that off of the table. What you are looking at currently is the market is trying to price in an economic recovery, or at the very, very least, an economic stabilization. Now again, a lot of people are thinking that the rally that we are seeing right now is unwarranted, or at the very least potentially a little bit too early. But let's not forget that the market is forward-looking. So the market is clearly focusing on times it doesn't look like we're going backwards. Mm-hmm. It looks as if we're moving forward, and the market is pricing in this idea that things are definitely, or at least it appears that way, are moving in the right direction, and we will be getting better in the next couple of quarters.
So are we coming up to a kind of a key breakout stage here?
We've already taken out a key resistance area, but we have not broken through the very top end of the highs that we had seen last month. So we have already done some very good price action from a technical perspective, but we do have to convincingly break out of the highs that we saw last month in order to really energize the second leg.
So, Charles, what we've seen so far, apparently, is stocks popping up on small pieces of good news, not going down too much on negative news. So more people now getting more willing to accept those small pieces of good news as positives?
Well, last week was interesting because we didn't really have that great a volume. And if you really break down last week's rally, it had a huge jump up in response to Intel's earnings. And then Thursday, things were really flat until Nouriel Roubini got quoted as saying the recession is going to end.
And that was late in the day.
That was late in the day, caused a late day rally. But then that very next day, he came out and said my comments were misconstrued, taken out of context. And he actually said it came from a previous forecast where he said the recession would last 24 months. Mm-hmm. And we actually saw, if you look at the numbers, we actually saw a disconnect. A lot of the volume really went to the tech stocks with the best earnings. We saw massive volume in IBM, massive volume in Intel. Really, J.P. Morgan and Goldman Sachs met with a lot of empathy. With a lot of apathy, I should say. And I think when you look at the markets this week, it's interesting. We've only crossed above 946, or only closed above 946 on the S&P 500 once since last November. We hit that earlier this morning as we're recording this on July 20th, pulled back. We'll have to see how things happen. And I think it's really going to be a tug of war. Do people react to really good numbers out of the semiconductor companies, such as Texas Instruments, which reports tonight, or do they look at all these bank earnings, which will account for about one out of every four earnings report this week, and will we see greater apathy, and we'll see the markets actually pull back from that 946 level?
What do you think is the main driver here?
Yeah, I think we talked about it a good amount last week when we gave a preview of the earnings season. We said, okay, roll back 3 months ago, the expectations for first quarter earnings was if a company didn't go bankrupt, that was pretty good, okay? And that was kind of goes along with what Kevin's saying about everyone was baking into the cake the worst possible outcomes, and so now that is off the table. We're not going into the abyss. Okay, so now what people need to see in the second quarter numbers was stabilization, and they are clearly seeing stabilization. That the second quarter is as good as the first quarter, if not a shade better. So a shade better, which means that we have made bottom. We are maybe a notch better than bottom. Now, going forward, the market's going to need to see something that's a little more a sign of growth. But this is stabilization. It's absolutely showing up in the numbers. Corporate America is doing a fine job fine-tuning their balance sheets and cutting costs. The top line still not really there yet, but the top line is in line with the modest expectations that were set out. So with the absence of bad news, good news prevails. You rebound from 8,100 to pressing towards 8,800 on the Dow today, and the earnings is what's gotten us here.
So there are still a lot of people out there, though, calling for or saying that the economy has not bottomed yet. So then what you're saying is the market can bottom because it's a forward-looking indicator prior to the economy bottoming. That's normal.
Well, first of all, there's a lot of people who are saying the economy has bottomed. Okay, so here, sorry. You're talking about the article that just came out last week. I think it was 55% of economists say it has bottomed, 45% say it hasn't, or it might have it backwards. Let's just call it 50-50.
In other words, there are people on both sides of the argument.
Right. If you take a look at the history of that panel of economic predictors, they do a very poor job. I'm sorry, they're always behind the curve. I hate to bring up Ross Perot, but he said, if economists are so smart, how come they're not richer? And I think there was right.
It's a valid question.
Right, it's an excellent question. So they're just behind the curve. So let me tell you that 2-3 months from now, I think that they will be saying 75-80% that we have seen bottom in the economy.
Okay. So where are we going from here, Charles? As far as longer term, what does this mean?
Well, I think we need to see conviction on the part of buyers. And right now we've seen a lot of fund managers sitting on the sidelines. They're continuing to sit on the sidelines. We can see this with volume that continues to be really light. And even though companies are coming out and beating expectations, and we're seeing a wide number of companies beat expectations, it's really not getting a lot of people off the sidelines. And I think although you are looking at the economy, really the pace of deterioration continues to slow. We're starting to see some numbers actually show signs of expansion, such as the leading indicators number, which came out this morning. We're seeing some others are suggesting very slow pace of contraction, such as the Philly Fed index, which came out last week. So we are kind of heading to this point where we're seeing the recession is near its end. But when you look at the other side, okay, if the economy is bottoming out or if it's nearing bottoming out, what does the flip side of it look like? And I think that's where a lot of question marks really arise, because I don't think we're looking at a very fast recovery. We're looking at a slow recovery. And so when you have a lot of fund managers who are looking at stocks that have risen 50, 60, 70%, off of the March lows, they're stepping back and saying, what do I do in terms of not putting my clients' money at risk? And until we really see a lot of these fund managers move off the sidelines, I think we're stuck in a prolonged trading range. The only question is, what's the upper limit for that trading range? And we might find out by the end of this week.
So those fund managers are not yet willing to take on a lot of risk, is what you're saying?
Yeah, a lot of institutional managers are sitting on the sidelines, and they're still being very cautious about what they do. But we can look at IBM, we can look at Intel and see where there was good earnings news, and where they can actually see a recovery is coming down the road in 2010. They did step up and buy those stocks. Intel traded on 3 times normal volume, which is something very unusual for a Dow component.
Kevin, you buy that argument?
Kind of. Let me tell you, one of the reports that I do look at quite regularly is the State Street Investor Index, and that basically shows portfolio managers and institutional investors' willingness to take on additional risk. In other words, get into equities. And for month after month after month, you have seen that index go up. So are they all in? No, they're not. But are they seemingly getting more bullish? Are they willing to commit more money that had been sidelined, put that money back into the market? The answer is unquestionably yes. So I believe that this is good foreshadowing for the market. And again, everything is relative. There seems to be a disconnect with the market and the economic reports that we're looking at. But again, the stock market is a forward-looking mechanism. So I believe, if I were to look forward, I believe that this next leg up could potentially see the Dow Jones get as high as 9,500 or potentially hit that 10,000 level that we had talked about, or at least I talked about several months ago. And the S&P, I think you have a real possibility of getting to that 1040, 1050 area. And that's not pie in the sky. It's only an additional maybe 8 or 10% from where we are right here. So I think that could be where we're headed. I think in order to bust through that with impunity or any kind of real conviction, you're going to have to see some really good numbers, not only in Q3, but also some real economic reports that are pointing to an economic recovery. But I do think that with what's happening right now, there's a chance that we may hit that 10,000 level or somewhere in that area.
He's quoting numbers now all of a sudden.
You asked where we go?
Now that his
did it.
numbers don't sound as insane as they used to, and I think he actually, if you pull back to the stuff that we did in December, his predictions are actually right now closer than some other folks sitting at the table here. So we made fun of him at the time, but I think he timed it out a little bit better than we did. But in terms of the going forward, if people were looking for the speed and velocity they got, bouncing off the bottom of 6,500, it's just not there. Those things only happen every now and then. But what is the general direction? The general direction is up. Okay. Now, I think that Kevin's end-of-the-year predictions are not far off the mark. And here again, now we're starting to get to reasonable rates of return. So if the average market return is 10% per year, then that is not going to be then that's what I would expect here for the next couple of years. What people misunderstood when we came off the bottom was, the economy is going to get better and we're going to have that V-shaped recovery. It's not V-shaped at all. I don't know what shape you call it. It's just a long, extended, slow ramp up from bottom is what we're going to have. But it is a ramp up. And so therefore, earnings will be coming up, and what people are willing to pay for those earnings will come up. So I think that the general market direction is higher, but it's not gangbusters higher. Okay, that gangbuster higher move already took place from 6,500 to 8,800. Now we're getting back into a more normal set of circumstances.
All right, that's the latest thinking from our panelists here at the roundtable. And if you want the latest in commentary on earnings and the markets and a lot of other interesting items that are written about on Zacks.com, then you need to bookmark Zacks.com and check it often, because there is always a host of interesting commentary and insight there available to you. With everyone here, I'm Terry Ruffalo.